Today we're looking at the ISM data, so ISM manufacturing and ISM employment, to see whether there's any gauge for the US economy going forward. And then the trading takeout today is going to be buy shares of companies that you use regularly. But before we start, make sure you click like and subscribe so that you can see these videos every single day to improve your trading edge. So at 2:45 to 3 o'clock today, UK time, we have a whole host of quite important data on gauges coming out. So 2:45, we've got the global manufacturing PMIs from S&P. We have then at 3, ISM manufacturing employment index, manufacturing new orders, manufacturing prices paid, construction spending, and the manufacturing PMIs. Now, manufacturing PMIs give a fantastic gauge of demand, and they're probably the best gauge of what's going on in the real economy. Remember, a lot of the financialization, the tech side of things, that's not really the real economy. It's not identifying specific supply and demand in the economy for things like making, goods and making things that people want to buy. So this is where looking at manufacturing really comes into play importantly. And one of the things that I'm focusing on at the moment is employment. I think that continuing claims, so the amount of people claiming unemployment in the US has been steadily rising for a good number of weeks now. And so I want to see today if that's going to be reflected in the ISM Manufacturing Employment Index. The previous print was 46.8. Now, if we start to get worse than that, it's already contracting, it's sub 50. If we start to get worse than that, then that is showing a deterioration in the employment climate. And the reason why I'm focusing on employment so much is because if people aren't earning money, firstly, they can't apply for any credit. You can't get credit out really if you're unemployed unless it's super high interest loans, which then means that credit slows down in the economy, which pretty much is one of the main causes of recession. If credit slows down, then things stop getting purchased. It's crazy, I know, that debt fuels everything, but it is what it is. It's a bet on growth, basically. And then if that occurs, then we tend to get a really illiquid economy, a really illiquid period in financial markets, which then, causes a downturn. So things like the employment index, things like new orders, things like prices paid will all show the extent to which demand is slowing down. And I think the new orders will be quite important as well. We had a really quite big slip on that, 45.5 on the previous number. Now, I would expect if this is bad data for the euro, which actually started to get a motor on yesterday from when I mentioned it, this is the 15-year trend line up here. It really started to push on through. And do you know what? I wasn't actually around yesterday to see this, but I'm short from up here. And this was a real push through, and we should be targeting this low in my view. And if this data does deteriorate further, like we're looking at today with the manufacturing PMIs, then I think what we will see is a bullish dollar environment. We saw risk come off as well. If I go to the S&P 500, saw risk come off a little bit yesterday, and then we rallied into the close. But I think that the way that the market is shaping up here is that if we do start to get deterioration in data, a worsening employment backdrop, then that will be a trigger for broader risk off sentiment. Right now, though, it's not identifying that. Employment is 100% the sort of missing piece to the puzzle. You've already got the curve inversion, so the the 3-month, 10-year curve inversion, 2-year, 10-year curve inversion. Pretty much the whole curve is reverting. It's gone from inversion to now reverting. And so this is a recession prelude, if you like. I think that's the right word. And employment is 100% the last factor involved here. If employment goes, the government and central bank will have to act, basically. So I think looking at how FX tends to dominate the move initially is the way to go with this. I think, we could see a rally up here to test and see whether there's actual resolve in the market to keep it a little bit lower. You can see that there's been buyers pushing up into here, and then the sellers stepped in really, really heavily and smashed it back down again. I would look for another test up here, back into the 1.09, 1.05, 1.095 level, and just to see whether there's real sellers that step in again. But I don't think any of the key levels yet have been specifically touched. We can draw a little trend line. This isn't very scientific. I'm not the biggest fan of short-term trend lines, but you can see maybe even that this trend line is matching up with a move up into here and perhaps lower touching here. But that's possibly the way that I'd look at it. It really, really depends on how bad the data is. Later on, if we get a real surprise, then expect the dollar to go absolutely parabolic. I think people have been short the dollar heavily, so bear that in mind as well. The pain trade for the dollar is dollar strength, which means weakness in euro dollar. Here's a great, really short trading takeout, and it is: make sure that you invest in the shares of companies that you use regularly, because if you're using them regularly, so will many other people. And this cements their place as a real leader in the industry.